Hi everyone, and welcome back to Risk and Compliance. This week we are looking together at banking compliance. Now, I suspect that what you're thinking at this stage is that, oh no, banking compliance, that is not going to be super interesting and that's likely going to be heavy and technical. Um, well, you are forgiven for thinking that, but in reality, what's interesting with banking compliance is that first of all, we are in Hong Kong in an international financial center, and the way banks are regulated here is extremely important for the economy as a whole. It is a very important source of jobs and kind of wealth creation. But at the same time, banking regulation is not just about the banks, it's about the entire economy, and very often it gets political in somehow the most interesting way. Things get political, meaning when there's a lot of money at play and when people tend to disagree about what to do on certain topics. Now, without further ado, please move with me for this week's program. On slide 2, we're going to look at three main topics. First of all, why? What is the reason for all these rules? Why do we do all of that? Why are banks so regulated, and some are even saying over-regulated? So number one, why regulate banks? The second one, what do we mean by banking regulation? What is a banking regulation, and what can banks do and cannot do? What kind of obligations do they have vis-a-vis the government or vis-a-vis the regulators or even maybe the legislator or their customers? What are their obligations? The third one is how. What kind of regulations do we have, and why do we choose to maybe regulate banks more or regulate banks less, or maybe leave it as it is? These questions are quite interesting. We're going to look at them in detail, and as I said, the first one is why regulate banks. So please move with me on to slide 3. Why regulate banks? What makes banks so peculiar, so particular, that they require such a heavy regulatory framework? There aren't too many things that are as regulated as banking. There are sectors out there which are very regulated: transportation, telecoms, any industry that has an impact on the environment, for instance. But there are very, very few regimes, very, very few industries which are as heavily regulated as banking. Now, for this kind of first look at the topic, we had 3 short videos to look at. And I hope you found them interesting. I hope you found them maybe even slightly entertaining. The first one is called 1 Minute Economics. It's a series of lectures that I find quite interesting because I have personal interest in economics, but also because I think their explanations are very simple, very straightforward, and very often just allow you to get a grasp of the topic very quickly. Now, you're probably too young to remember what happened in 2007, 2008, but this was a terrible moment for banks, of course, but also for the global economy. Very, very quickly, after the collapse of some banks in 2008, a lot of people predicted that the world will take a long time to recover from that. And in many, many sectors, in many areas, the world has never fully recovered. The number of jobs, the amount of investment has never really reached the level at which it was before 2007, 2008. Our first video explains the Great Recession, and I think what's interesting in this video is that it really explains that at the center of the global financial crisis in 2008 are the banks, right? And obviously this is the topic of this week, so we are interested in what exactly happened with banks. Now, in particular, what we see is overlending, right? We see some banks which were lending too much money. They were lending too much money to individuals who should not have been able to borrow that much. And they were lending a lot of money to companies which didn't necessarily have the money to repay these loans, right? So we see a sort of race for profits. We see unrestricted lending and maybe not enough rules or not enough compliance of existing rules around lending. Another issue is that these loans were then packaged and cut into financial products which were then sold from a bank to another. And so when people started not repaying these loans and defaulting on these loans, meaning not repaying when they're supposed to pay, the banks started looking at all these financial products that they had and really wondering, how much is it really worth? If no one is really repaying these loans, how much is this loan really worth? Maybe this loan is worth absolutely nothing. The banks had a lot of these products, and they were also lending money to each other. So they stopped lending money to each other because they thought, if I think my financial products are worth nothing, what about my neighbor? What about the other bank? What about my counterparts? Maybe they are worth nothing either, and maybe they know nothing about their own balance sheet. So they stopped lending money to each other, and very quickly the world economy came to a standstill. I personally was just like you, an undergraduate student in 2008, and I still remember thinking, reading the newspapers one morning, I should probably do a PhD or anything that's going to delay my entry on the job market by a few years. And indeed, it was a good idea because there were simply no jobs at the time, no one was hiring, and there just wasn't any kind of bright future waiting for us. And it was a good idea to delay everything by a few years, because the first few years, 2009, 2010, 2011, were really, really tough. And only slowly 2012, 2013 did the economy pick up slowly. Now, document number 2, it's also a short video on YouTube, and it's called History Brief, Black Tuesday. Black Tuesday is a very famous day in finance, 1929. Wall Street goes in full panic mode. Everyone is selling shares instead of buying. The price is collapsing. And even at these very low prices, no one wants to buy, and a lot of shares are now worth nothing, meaning the company is worth nothing. So these companies close. A lot of people lose their job, a lot of people lose their life savings. But we can see a difference here between 1929 and 2008. Is that in 1929, this is not about the banks. This is not about the big financial institutions. The financial system as a whole might be a problem, the way it's set up, how much people can trade, and whether their investment is genuine and rational rather than speculative. But in reality, in 1929, the problem is not the banks. And that's why you have these 2 videos, right? Document 1, document 2 show you that the problem has changed. In 1929, the problem was not the banks. In 2008, the problem was the banks. And the origin of the problem and the origin of the financial crisis in 2008 is the banks. Document number 3, I hope you enjoyed it. It's a very old movie. It's from 1946. It's A Wonderful Life. It's a classic movie by Frank Capra with James Stewart. I don't know if you've ever seen it before, but it's a very classic movie of the story of a man who is very depressed psychologically, but then through very bad times, he's going to realize that he actually likes his life, and that's why the movie is called It's a Wonderful Life. But there is that very interesting scene, what we call a bank run, in 1929, and that is what this scene is describing. In 1929, when there was a problem, people would rush to the bank and try to get their savings out of the banks because they were afraid the bank would suddenly collapse. Understand the difference between 1929, the bank is the victim of the financial crisis, versus 2008, the bank may be the origin and a real genuine problem in the financial system, which leads to financial collapse and crisis. Try and keep that difference in mind as we move towards today's lecture, and try and realize what kind of reason pushed us to regulate banks the way we do that today. We move on together to slide number 4. Why regulate banks? The main reason is their role in the economy, right? What is that role? They are lenders. They lend money. Actually, another way of calling a bank is a lender. You might open Bloomberg, you might open Reuters or the Financial Times, and it says, oh, Germany's biggest lender. We're actually talking about the bank. A lender is a bank. Lending, ensuring the circulation of money, ensuring that people have access to the capital, to the capacity to invest that they need when they need it, so that they can seize the opportunities for investment. This is what banks are doing. No company at the moment has $1.5 billion to invest for their next acquisition. They're going to raise that money, they're going to borrow that money, often through banks, either directly through the bank, borrow money from the bank, or use the bank to find investors through, for instance, selling bonds. There are other ways of financing yourself, but bonds and selling equity shares in your company, and at the same time raising funds through the banks directly as a loan, are the main ways to finance your acquisitions. all of these need to go through a bank, and that's the role of the bank in the economy. That is one of the reasons we regulate banks so much. Why is that a risky activity? Well, think back about document number 1, right? Raise for profits. And this is something that is touched upon in document number 4, for instance, document number 5. The risk that a bank goes for profits, higher profit, too high profit, is something very serious that needs to be taken into account when deciding how much to regulate banks and how to regulate them, how much the regulators, how much the government should be concerned about what a bank is doing on a day-to-day basis. The banks are also potentially heavily leveraged, meaning they don't have the money they lend. When you borrow 1 million from the bank, they may not have 1 million. They only have 100,000, and they also borrowed the rest of the money. Now, it might sound not very logical to borrow money to then lend it to someone else, but it depends the interest rate, right? If you can borrow at 3% and lend it to someone else at 6%, you just made a lot of profit, which is what banks are doing. Very often they do not have the money they are lending, which means their activity is risky. They are, we said it, sensitive to economic conditions. Think about document number 3, the bank run. Document number 3 is funny. It's an old black and white movie. It feels like a dusty story from the old times when people were rushing to the bank. But it still happens. It still happens in some corners of the world. It still happens when there is a rumor that the bank is going to close, that people rush to the bank and try to get all their savings out before the bank goes bankrupt. It happened in 2008. It happened after 2008. It still happens a lot. Sensitivity to economic conditions. Number 4, potential misuse and potential wrongdoing by the bank. This is, of course, very serious, and also this is potential misuse of the bank by third parties. This is all the criminal activities that might take place around the financial system, through the financial system, thanks to the financial system, or against the banks, and this is why banking is such a risky activity. Now we're touching upon our second topic today, which is what do we mean by banking regulation? And there are a couple of subtopics here. The first one is licensing, right? So look at licensing. I put here 3 categories of banks, right? On the left, I put Dashing and Citibank. This is an example of fully licensed banks. What do we mean by fully licensed banks? They are banks, right? This is simply a bank that can do anything. They can borrow, they can sell bonds, they can exchange money, they have branches in the streets, they do commercial banking, they lend money to companies, they can underwrite bonds, they are a full bank, right? In the middle, you've got restricted license banks. Societe Generale, SocGen, and Bank of Shanghai are 2 examples of restricted license banks. They are not necessarily smaller, but in Hong Kong they are, right? This is how we regulate in Hong Kong. So SocGen and Bank of Shanghai are restricted banks. They can't do everything. They can only borrow or lend money above a certain amount or below a certain amount, right? This is all explained very clearly in document number 6, and this is where you should really prepare for this kind of lecture and really look at the documents before you look at the lecture, or when you're looking at the lecture, pause this video and really look at the documents, because that will make sense if you have looked at document number 6, of course. On the right, we have Fubon and Chongqing Bank. What are they? They are deposit-taking institutions, right? They are much smaller than even restricted license banks. That doesn't mean that as a whole, globally, they are smaller, but in Hong Kong, they're just very small. Now, what's the reason for the 3-tier system? The fully licensed banks, Dashing and Citibank, might be unrestricted in what they can do, but they have lots of obligations, right? Every time they do something, basically, they need to tell the government. They need to tell the monetary authority, the HKMA. The ones on the right, for instance, Fubon and Chongqing Bank, they can do less. They have less exposure to the financial system. They have maybe less leverage, right? They have more of their own money, so they pose less risks. They can do less, they are smaller, because of that they are less regulated. So it makes sense to have different types of licenses, because you don't want to impose the same obligations on companies, banks that are fundamentally different from each other, right? So please make sure you understand the HKMA 3-tier banking system as in document number 6. You're moving with me to slide number 6, And we said it's licensing. Licensing is restrictions per type of license and also restrictions of the range of activities that can be regulated. The key word here is that the more risks an institution poses to the financial system, the more regulated it is. We're moving on to lending. Lending is our second subtopic to the question, what do we mean by banking regulation? Very interesting, on slide number 7, lending. Lending is the number one reason banks are regulated. Why? Well, because this is the main function of a bank. We regulate lending as the number one activity of banks because this is the main thing that they're doing, right? They take money from one person and lend that money to another, and this is their number one function. The regulators, often a central bank, in Hong Kong it's not exactly a central bank, it's the HKMA, the Monetary Authority, impose what we call a reserve requirement. Remember, we said banks do not necessarily have the money that they lend. With something called the reserve requirement on banks, regulators make sure that banks have at least a certain amount of money. It might be 10%, it might be 20%. It's a certain number, often around 10%, of money that they need to have as a reserve when they are lending money. So that's one of the ways we regulate lending. Another way is also to regulate who can borrow, or how much, what's the maximum amount, or how long do they need to wait, or what kind of documents do they need to bring? Do they have to bring a guarantee? Do they have to bring another person who's going to say, well, I'm going to borrow 1 million, but if I don't pay, this person, number 2, is going to pay for me. That secures the whole financial system, but it also makes it harder to borrow. We will study later in this semester risk. And in risk, we're going to talk a lot about lending, so I don't want to go too much into lending. And in that sense, today's lecture is partly an introduction to banking compliance, because a lot of the things we're going to see today, we are going to study them later on this semester. So do not worry too much about these topics. If you don't necessarily get a full idea of what's happening, just make sure you read the documents, just make sure you come prepared and you come ready to discuss this in the lecture. But at the moment, we are only brushing the topic, and we are looking at lending as, first of all, the first reason why banks are regulated, because this is the first thing they do. And second, there are different ways of regulating lending. So how much you can lend as a bank, how much you can borrow as a person, as a borrower, to whom, to do what, and how much transparency there should be, for instance. These are all the things that governments are going to sometimes regulate. We're moving to slide number 8. Slide number 8 talks about payments. And payments is very, very interesting. The reason is that it's booming. It's changing a lot. It's a fast changing world. The world of payments is extremely interesting. There is a lot happening at the moment. The way we do payments, the way we think about payments, the way we regulate payments is fast changing. What I mean here is that there are lots of jobs at the moment in payments, in particular in Hong Kong. Hong Kong is fast becoming the center of Asia for fintech, the center of Asia for payments and e-payments, and there are lots of jobs in business and in legal and compliance in e-payments companies. I really hope that you will give it a thought when you are embarking on your professional life, because there's just a lot happening at the moment and it's becoming extremely interesting. We are more and more using our mobile phones to pay. We are using even less and less on credit cards, for instance, and other types of payments are becoming prominent. We are talking about bitcoins and how to regulate bitcoins and cryptocurrencies. All of this is happening right now, and you can be part of the conversation. If that is something you want to do, this can become the first step of your professional career if this is something you're interested in. What do we mean by regulating payments? We mean the transfers of money between a person and another, between a bank and another. We are regulating how much cash you can use. In some countries it's limited, in some it's not. You can bring as much cash as you want in Hong Kong, it's okay. You have to declare it. But you can bring millions of dollars through the border if you want. Now, most of the time, the country from which you're coming has a limit on how much you can take out, so you might breach the rules on the other side. But as far as Hong Kong is concerned, you can bring as much cash as you want. It's interesting. It says a lot about how welcoming we are to capital and how little questions we ask sometimes about where the money is coming from. We are regulating the modes of payments. Every single way you use to pay, from cash to check to e-payment or QR code, is subject of a different set of regulations. We're regulating the modes of storage. You store money at a bank account, or you store money on an e-wallet, or you store money on a cryptocurrency, on a ledger. These are all regulated differently. And of course, foreign exchange, how much can you exchange, at what rates, who can do the exchange for you? Do you need to provide a proof of identity when you are changing $10 million, $100 million, or $7 or $700 simply at the shop downstairs in the street? Do you need to provide a proof of ID? In Taiwan, yes. In China, yes. In Hong Kong, no. You can change as much cash as you want. You do not have to prove your identity. That's quite interesting. Increasingly, payments are seen as their own industry rather than simply a part of banking. If you wanted to do e-payments, if you wanted to create a company that allows people to pay with a QR code, 5 years ago in Hong Kong, you needed a banking license. Not anymore. Why? Because we changed the rules. This is why you have a document that talks specifically about this. Document number 11 allows you to understand that we have recently changed the system to allow smaller companies, and sometimes bigger companies, to offer payments as an activity that has nothing to do with banking anymore, except it's connected to banking, because you can transfer money from your bank accounts to maybe your TNG accounts, to your Alipay accounts, to your WeChat account, or to your Octopus app, but it's not bank. How does that work? Well, look at document number 11 and you will see that we have simply designed specific rules that reflect technological changes and innovation and the demand of the public for more convenient, faster ways of payment. This is very interesting. This is happening right now. Move with me to document number 9. Document number 9 is also, slide number 9. And slide number 9 is connected to things that we will see later. We will study anti-money laundering, financial crime, and financial misconduct. Probably so much that you will be sick of it at one point. So I'm not going to spend too much time on these topics right now because we have a couple of weeks later on this semester on these topics. But think about all the ways that things can go wrong in banking. Money laundering, of course, but also corruption. Trying to avoid economic sanctions against countries that are target of sanctions, such as Iran or North Korea. That happens all the time. Financial misconduct by the bank, against the bank, or fraud, simply fraud by the bank through against the bank or through the bank. There are 3 objectives in these rules, and they're very simple. It's to protect the bank from people who try to misuse it. It's to protect the economy as a whole against the acts and the misdeeds of banks, right? Simply bankers in themselves, which sometimes can breach the rule and engaged in money laundering or fraud or theft. This is our second objective. And of course, the third one is financial security as a whole, and just making sure that we know what's happening, we know where the money is, we know we have a trace of what bank accounts belongs to whom. These are relatively important topics that are, of course, the subject of lectures later this semester, so do not worry too much about this. Instead, please look at slide number 10 with me. How do we regulate banks? We are gradually touching upon the end of our 3 questions. And the last one, how do we regulate banks? I do not mean by that, what do we mean by banking regulation? This was topic number 2. How do we regulate banks is more about the evolution of this, right? Do we regulate banks in a very strict way? Or are we soft with the banks? Do we regulate them less and less? After 2008, a lot of countries decided to regulate the banks very strictly, but today, that was 10 years ago, a lot of things happen, a lot of banks look a lot more stable than they are, a lot of economies look a lot more stable than they are. And for that reason, a lot of governments are questioning whether we should continue to regulate banks the way we did. And for that reason, it's very political. the way we regulate banks, the decisions we make in relation to banking regulation are highly political. Think about the role of state-owned banks, for instance. State-owned banks, banks that belong to the government, are also actors of the economy, and necessarily when the government imposes regulations on banks, it also imposes regulation on itself and on its own banks that belongs to the government. That alone can make it extremely political. For instance, in China, where all the biggest banks in the country are state-owned, they are not private entities, they belong to the government. Right? Different approaches in different jurisdictions mean that depending on who's elected, depending on what the political climate is at the time, the rules can change dramatically from a country to another. There are countries in which banks and other financial institutions are not necessarily the subjects of a lot of government regulation, but they are subject of self-regulation. In Hong Kong, for instance, the government tends to trust self-regulation by the banks, so the capacity of the banks to get together and together decide who should do what and who should lend to whom, who is responsible for lending, who is responsible if something goes wrong, what kind of reporting obligations do you have. A lot of these in Hong Kong are determined by the banks themselves, not by the government, which means the government trusts them. And instead, the government regulator, the HKMA, is not really a very powerful enforcer. It's not a very powerful government agency. Consumer protection dimensions, of course, because the more you regulate banks, the more you protect the consumers, because at one end of a spectrum, you allow the banks to pretty much do whatever they want, and which means they're going to lend a lot of money, and it's great for companies, but that might not be that great for customers, because they're not necessarily protected when you say, for instance, that a bank can lend as much as it wants, or that it can refuse customers if it wants. Then the bank is free, for instance, to maybe deny loans to a certain type of people, or to discriminate against some customers. On the other hand, if you regulate a lot, if you impose a lot of regulations on banks, then as a government you can say, well, you cannot deny a loan to this person simply because this person has this type of job, or because this is a small business, and you have to treat everyone absolutely fairly. So there's a consumer protection dimension in banking regulation that we're going to talk about very quickly, right? And then don't forget that this is all very competitive. The countries, the jurisdictions like Hong Kong need to compete against each other. Hong Kong versus Singapore, London versus New York, Tokyo versus Seoul. These countries, these jurisdictions need to attract capital. They need to remain the international financial platforms that they claim they are. And for that, sometimes they need to deregulate, even though it's not a good thing to do economically. We're looking at 3 examples. The first one is Europe. And on slide number 11, MiFID II, there's a quick summary here of what is MiFID. So MiFID is a new regulation that came into force very recently, and that affects everyone, but mostly investment banking in Europe. Not only in Europe, you have one document in particular which discusses whether this is also affecting other jurisdictions. That's document number 15. It's a summary by EY on who is affected by MiFID, and this is why in Hong Kong we talk about things like MiFID, because MiFID, the new regulation of investment banking and investment activities in Europe, is having a very strong impact in Hong Kong. What is it? It's an extremely complicated piece of legislation. It is 30,000 pages long, 1.4 million paragraphs. I know it sounds absolutely crazy. I encourage you to have a look and try and make sense of it. It's extremely complicated. What does it do exactly? It creates pricing transparency for off-exchange markets, which means that you can't really sell financial products anymore with a single price or a wholesale price and not explain to customers what is behind the price. As a bank, when you charge your customers, your investment customers, you cannot anymore charge a single commission for investment and analysts. You have to explain to them what is research, financial research, economic research, and what is trading commission, meaning how much do you charge for each transaction. Lastly, tougher standards for investment products, and so that means investment products have to comply with a certain number of regulation. They have to comply with stricter requirements in terms of quality, what is in there, how much do you know about your own financial product. Think back about document number 1, global financial crisis was also about financial products being unclear, right? So we see that 10 years after we have these new rules, it takes a long time to write these rules. 10 years after we have these new rules which say financial products need to be clear and we need to know exactly what's in there. MiFID is extremely complicated, and very likely some of you will have to work on MiFID when you reach the first stages of your professional life, because it's just a lot of work. Try to imagine 1.4 million paragraphs, 30,000 pages. It takes a lot of people to decipher it, to explain it, to enforce it. Move with me, document number 12. We can see that the Trump administration is deregulating the banks, is removing from the Financial Consumer Agency the ability, for instance, to go after discrimination cases in lending. And we see, you have a couple of documents which talk about this. We see that the Trump administration in the US, document number 16, number 17, is really trying to scale back the amount of regulation that has hit the banks in the US. This is also something very interesting that's happening. Slide number 13, sorry, HKMA versus Association of Banks. Is this the Hong Kong government that's regulating banks, or are the banks regulating themselves? This is all happening in Hong Kong. Have a look at the documents for this week. Try and go through the news, try and go through newspapers and clips or pieces of information on Bloomberg to try and understand what's happening exactly these days in terms of banking regulation and banking compliance. We will talk about this a little bit more in detail together, but I just wanted to give you that first heads up about this week's topic, which is banking compliance. I hope you found it interesting. If you have any questions, please let me know. If you're interested in more, you have a couple more documents in the reading list. Document 18 about banking regulation in China. Document 19, what is the effect of banking regulation on banks. Document 20 is about the amount of regulation that's coming from Europe. And remember, this is affecting the entire world of banking. If you have any questions, just let me know. You have my email if you have any remarks, any suggestions with this course, anything you wanted to talk about, please let me know. And in the meantime, please come prepared to discuss this together. Thank you very much and see you very soon.